SBA 7A loans, debt service coverage ratio calculated, and your borrowing power, plus interest rates in Hybridge SBA 7A loan up to 5 million option, Express and Standard 7A loan, also 0% interest for 6 to 18 months. Hi, welcome in. This is Michael with Viral Funding Solutions. I'm a business loan broker expert who's been able to help a lot of businesses not only get an SBA loan, but other types of financing, unsecured or secured, meaning without collateral or with collateral on top of so much more. So please stick with me until the very end of this video so you get to see all the juicy details on different types of financing and what you can do. So this may look familiar. I just recently released a video. In fact, I went live on the channel and it should be up now that I'll link you to down below in the description, where I go over more so the interest rates today on SBA 7A loans, primarily speaking. And I wanted to add this on top of it, but I more or less ran out of time and I kind of forgot about it towards the end, but I had it all done. And so I went ahead and made a separate video for it. So come in, we're open. And what I want to say is now is the right time to get in to get financing. I'm making this just before the end of 2022. And as interest rates are soaring, home mortgages and everything else included, I mean, this is business funding, so it's different. You have a prime rate right now at 7%. Now, when you're watching this, that could be higher, more or less, a fluctuation caused by inflation, economy shifts, and a few other things. But at 7% prime rates right now, there's a plus percentage on top of that. So what I would recommend if you can get an SBA loan is do it before it gets too late. And at a base point, maybe you're looking at 10% and above. You can no longer get in less than 10%. And even if it's a bit higher, it's okay because the term will overcompensate for that and keep your repayments less. And if you can't get an SBA loan or it's okay. It's not about that. It's about the benefit exceeding your repayments. So what do I mean by debt service coverage ratio? And I have a few things here already, but DSCR stands for debt service coverage ratio. And just in basic words, it means how much cash flow does your business have in the ability to service the debt that you currently have, that you will take on, projection value, etc. But it's looking at the health of your business overall and asking, okay, how much debt obligations do you have? If we gave you more debt on top of this, how much cash flow will you have on hand? What would you have remaining in the bank? We don't want to get you into insufficient funds. Now your overdrafts and you don't have enough cash flow. Other debt is being taken on. That debt is adding on top of more debt. And so we lent you money on something and we took out more money than what we needed, or you ended up defaulting and ended up getting into a bad situation. So just keep in mind that this is just an overall look at the gross revenue you're making as well. What's your profitability of your business? What expenses are you enduring? And what kind of debt are you taking on? So there's a formula to this. And I have a few examples. I actually wrote them down right here on my paper. So I'll try to write them on the screen here as we go with different examples. But yeah, I wrote just a few of them. And this is what I do a lot of the time when I pre-underwrite a file. And this is what a lot of the times you'll see with lenders, but they do a little bit more too that they do on their end because of their systems. So this isn't by no means going to be exactly towards you per se. Like this is what you ultimately will be getting because there's a range to this. And we also have to look at more, not only the tax returns, but year-to-date financials, profit and loss, balance sheet to see your overall debt. What kind of assets do you have on hand so we can try to readjust and perhaps get you more with maybe more terms. So here I want to get into this. Now you also have EBITDA. This is earnings before interest, taxes, and depreciation. Excuse me, I was looking at the word up here. Earnings before interest, taxes, depreciation, and amortization. This is used as an indicator of the overall profitability of your business. And I can look down here and I'm not going to spend too much time on that. That may look familiar. That's what the other video will down below explain about, but I may touch upon it if we have time. So over here, we have to have some types of formulas to be able to calculate debt service coverage ratio. And there are circumstances where you will know it because of the lender we're working with. Now that can be readjusted because of a few things. Your net operating income, or for short, NOI. And this is probably something you're familiar with, or you're like, oh, or you don't know, but this is some stuff we can find like tax returns, your profit and loss statements more so, and get to see what your net income is, your net operating income, whether are you profitable or you're not profitable, what are your expenses underneath there, interests, mortgages, anything you're paying that we need to see, gross revenue, cost of goods sold. I can go on and on. There's different sections for each one, whatever you have going for you. But just know that the SBA does require more documentation and more of a thorough look. So net operational income is what we're seeing. And if you want to know if you're profitable, the last 2+ years of profitability is best that we like to see, not that fluctuation of 1 year, then no, and then yes. Maybe some lenders, but not the majority of them. We want to see repeating patterns where we're like, and then we can predict what you're doing in this year, but at the same time, it can be a bit difficult in that regard. So you have net operating income, and then you have total annual debt service. So, what kind of debt, how much debt do you have? So net operating income, okay, you're operating at a profit. What are your revenues over your total annual debt service? What are your obligations? What kind of interests and principal? All of these things included. And if you didn't know the net operational income, and this is stuff that I do, and I can look at tax returns, profit and loss statements year over year, see the percentage of profitability, if any, and the percentages year over year. And if there's no NOI, I can get that calculation out in various ways and what I need to add and subtract. So adding gross revenue and taking away from expenses and a few other things. And there's also EBITDA. And then I can take that formula and divide it by principal and interest and a few other things and components to figure out more if that's the case. But NOI, and there's a lot of this in different formulas that I do that I can do on hand. I can put it into an Excel spreadsheet and what lenders will do as well, and more so. So what we want to do is figure out what is our DSCR in this equation. So we'll say up here, our given, in sciences, I used to do this a lot, but it usually was 1G. So we're given our net operating income. We know our total annual debt service. Let's start off by figuring out what is our debt service coverage ratio. Down here, then we have a formula. It might not look good here, but I have it on paper. So let's say for the example that you are operating at an income of a net operating income here of 100,000. Now we know our annual debt service, and we say here for this example, there is 80,000. Simply speaking, that will then determine our DSR. And our DSR, we could have done it this way. Or I could have just shown you from the beginning. So NOI divided by DSCR, or there's a different way of figuring that out if you're looking at total annual. If you're looking at total annual debt service, there's different ways of calculating certain ones. So NOI divided by total ADS, we'll put there, is equal to DSCR. So we take that, and we know that 100,000 divided by the 80,000 that we were given, and I would put labels on this, but we're doing this because of time, then that should be coming out to about a 1.25 DSCR. And what this DSCR means, if I didn't, yeah, I did pretty much say, that $1 for that going towards debt, you're making 25 cents, or 125, it has to be 125 times greater net operational income than your debt, your total annual debt. So that's going to help suffice us how much we can actually lend you and a few other things and circumstances. So we know our 1.25 debt service coverage ratio for this example, and I have it written right here. And again, we're doing it on an evaluation. We have different numbers now. So let's come up with, and then your interest rate can be evaluated, risk associated, term length, the maturity and the amortization of it, as well as the amount of funding you get. But let's say the prime rates being at 7% plus a basis of 2.25% if it is up to 10 years working capital, 7+ years, up to 10 years in working capital. We're not going to focus on up to 25 years with real estate on this one, or property mortgages and so forth. That could probably be for another time. But 7% plus 2.25%, you're getting over 350,000. Perhaps you're looking at 9.25% on this in terms of interest rates. And like I said, as the prime rate goes up and the risk association becomes a factor and how much the lenders are actually willing to lend, if they're giving you less, there may be an association with the interest coming up, or your payments may stay the same, but the term still stays the same. It's becoming a bit more expensive for you. And it's just a few things we have to calculate on that. So you are given 10 years here. Let's put time is equal to 10%. We'll say I for interest, or say in, and then well, I like to put interest, we're going to be given 9.25%. Over here, we have the DSCR is equal to 1.25. We have some of the other numbers. I can start listing all these, like, let me put them here. NOI being 100,000, and then total AD, we'll just say T8 tabs there for 80,000 in this example. Now we want to figure out a few things. What is our actual maximum loan amount that we can lend, as well as what can be our monthly amount that we can afford and we cannot go over. These are a few things that we have to take into account. So with that being said, what I take to find out my monthly repayment that I can afford at most, what I then want to take is the 80,000. I already have the number, but let's just do it here. I already have it on top of my mind. 80,000, I divided that by 12,000. Then I'm going to get approximately $6,667 is what I can afford to pay monthly. And I cannot exceed 80,000 yearly in debt. If I'm at 90,000, we're at a loss, and that can hurt you. So that won't work out on all parties. So you can afford to pay up to, we're not saying you'll get a payment of 6,667, some do, but we can afford to get you up to that amount over the time that we've been given here. So that's what our monthly repayment is. Now we want to figure out what our total is. So I've done some calculations on my end. There are some formulas that can be a little bit more complex to this. And there may be a calculator that works too. I can do it both ways. But pretty much we're seeing that your total payment on this one, that being $520,726.26 is the maximum loan amount we're willing to give you on the evaluation that you have a 9.25% interest rate. The time, it's 10 years. Here, your interest rate, it's at 9.25%. The SCR is at 1.25, and that's a minimum with an SBA 7A loan for the most part. Most lenders look at a 1.25. Anything underneath that, you're operating at a loss, no profitability. That's just too much expenses, too much things going to service the debt. And they can go lower, even with lower like express loans, they might be able to, but even at a 1.15, 1.2, but at a 1.25 is what you should be measuring that. So net operational income, 100K, TADs here, which was the total annual debt service, is at 80,000. We calculated our monthly repayment to be 6,667 approximately, and that's because we did the 80,000 divided it by the 12 months that we were given in a year, calendar year, not over the 10 years right here. So then we were given a 6,667 on that. So that's what you would expect to see in terms of that type of the equation. Let me just make sure I have another example here to share with you. And we can make adjustments, and I'll come back to, let's say you were, instead to get 10 years, you were given 7 years. Well, what can happen is we can see the payment being the same, but perhaps the loan amount usually will go down. So instead of getting 520,000, it could be down by as much as 100,000 more or less. So you might be looking at 420,000 at most you can afford. And if we do it by another 100,000, would drop the rates a little bit if possible. Perhaps you're already in the express loan range and you're still giving a high percentage. So over here, let's work out another example. So interest, let's just spell it out correctly there. Interest being at 9.25%. So we're more or less looking at prime rates plus 2.25%, more or less. But, oh, actually, sorry, 2.75. So let's do 9.75% there. Raise it up a little bit. And then this one is even in 7 years instead of 10 years. We still have the 80,000 for this example for our TADs there, total annual debt service. And there are different ways of figuring out these numbers that I can do. If I didn't get them, what's given, what's unknown, I can plug into an equation myself, just writing it out. And I can do a lot of this. And then here, what I calculated that to be, it's going to be about the same in terms of the 80,000 divided by the 12. You're going to see 80K divided by 12 months, and then you're going to be seeing at approximately $6,667, excuse me, that can you afford to pay per month. And then it cannot exceed over 80,000 again. And that number can shift depending on your total annual debt service, which we'll come up with another example. But maximum loan amount for this situation at 7 years, you're looking at a number of $404,740.17. Okay, you see how that number's gone down now. You're only getting 7 years. Payment may stay the same because of your total annual debt service, but we're seeing a maximum loan amount drop. And that can drop even more with rate increases or term length perhaps being shortened. And that's what you just see a lot of the time. So the last example, we were given 120,000 NOI. Oh, and if I didn't say this here, this is the same example where we were doing an NOI equal to 100K. I apologize for that. So this one, NOI, that's equal to 120,000 this time. And then we have our TADs there for short. This one was at 90,000. And then we have an interest equal to 9.25%. So still relatively low. Perhaps you're above 350,000 you're looking to get approved for instead of an express loan. That's not 11 to 11.75% or 10% in some cases, or in a lot, to be honest, that people end up getting. So here you're looking at interest being at that amount. We calculated our DSCR based off of that to be 1.33, and the higher number you have, the better. You're making more in your return instead of the 25 cents for every $1 that goes in to debt. Instead of 25, you're making 33. So I already know the numbers, but let's just, if we were doing this way again, if I were to know that, I'm given 1.33%, and that's bar over, continuing. And over here, now I calculated this to be over the years of 10 years. We're amortizing it, principal and interest. And so now our monthly repayment is equal to $7,500 at that amount. Okay, so how do we know that number again? We take the 90,000, we divided that by the 12 months in the calendar year, and we're given 7,500. That's the maximum amount per month you can afford. And if we want to break it down per year, 90,000, you cannot exceed that. So yeah, there's maybe a little bit more wiggle room there on what you can get approved for. And you're seeing that your operating income, you should have it increasing no matter what. And having a higher number is always going to be helpful, and especially if you want more initially. You can always try to do that over time. So the max amount of lending we can do here, it's $585,787.25, or I believe that's 75 cents there. So that's what the number comes out to be. So you have more now because you're working with a higher debt service coverage ratio. Now over here, we had 1.25, 1.25, but the difference is we had a shorter term primarily. So that would drop our maximum loan amount. So it's not to say you're going to get 585, 404 plus, 520,000 plus. It's saying that you're in that range. If you didn't get an express loan because you're over 350,000, you'll fall between 400,000 perhaps to or anything up to 520,000 regardless. But if you qualify for an express or pass an express loan of about 350,000, your range would likely look like 400 to 520,726 plus. Now, that number can be readjusted because there's some other evaluations like collateral, extending the term length. We can instead of giving you 400 to 500,000 more or less, we probably jump that from 500 to 800,000 or 600 to 800,000 with the longer term with collateral. So that number can then be reevaluated depending on what you have, what's appraised at, the value out of it, the equity, do you have any liquidity? A few other factors come on to the table when we look at that. But this is just a short form of looking at it. We can look at this and base it off year over year. We can see a pattern and we can say, 2019 was this, and then you have 600,000 there, and then you have 700,000. You're upwards, you're increasing projection wise, and it's looking better this year. So perhaps we can do an average of those three, or we can see a fluctuation here and there. So we go, hey, instead of getting you, between 600 to 700,000, we can do 500 to 600,000 there. And then over time, we build you up to more. You have collateral that can add up into the equation. But there are more factors we look at overall, which are business and personal tax returns, year-to-date financials, profit and loss, balance sheets that are an overall combination of what can get you approved for an SBA loan. But this is a bird's eye view of an up to 10-year working capital term loan. Express loans are usually 5 to 7, 5 to 10. It can happen. Sometimes even less than that, especially with acquisition loans, like 3 years if you're doing seller financing primarily. So there's a Hybridge SBA 7A loan option. It's the best SBA option to get started with if you are profitable within the last 2 years. Recently, it's best with stronger credits, and you need longer time for bigger projects with a greater return on your investment longer term, and not primarily just for relief in operational expenses, more so like COVID relief. Yeah, that can be applicable. But the lender also wants to know, like, hey, if we give you 7 years, we gave you 10 years, you're not just using this all for payroll, or are you using it for buying equipment? Are you using this for getting more inventory? That's what they also want to see. Now, it might not be the primary, but it should. That's what's going to help you get over that hurdle of approvals. So, not to spend too much time on this, the Hybridge is two separate loans. One is an unsecured financing product, term loan, line of credit, cash out, or cash advance. We can try to add a combination of the two, which can be funded easily and quickly and best used as bridge funding. In the meantime, you can get it while we're looking to get you approved for an SBA loan. A lot of people do this through me. This is the best way to do it. It's an in-house look with myself, my team, my lenders, and your information is privacy protected, safe and secure. This is the best out there. I work with the best lenders and underwriters and the best team, so you know what's happening. It's very punctual. I know what's happening in underwriting. I can communicate with you. However that gets communicating, I know what's happening. I know the offers. I know everything. So I'm always on top of this. I'm looking at the files, bank statements, everything that's necessary, not only for SBA loans, but other products. But it's used as bridge funding in the meantime. We can try to add that if you need something immediate and there's a benefit there, or you just need it for saving money, perhaps a line of credit, personal loan on top of that, or different various ways we can look at it, but have a benefit that can exceed the repayment, not all about the interest rates. The other loan, it's a 10-year SBA term loan, express loan or standard loan, which we can get a letter of intent within a couple of days, but it takes 6 to 8 weeks for actually you to receive your funds, with as low as 120 plus in annual gross revenue, 660 plus FICO, and 2+ years time in business is what you realistically want to have. But those are just like an entrance point usually to express loans up to 150 up to 350,000 to normally get above that 350K and even less, but you want to be doing normally north of 400,000 and above, 500,000 in annual gross revenue to get approved, that 350 to 5 million range more likely, and that's going to help your case a lot better. And realistically, at that point, you want to have 660, but 680 plus is better. Try to shoot for that. In addition, what we'll need, I'm going to quickly skim through this because I made another video on this you guys can watch. Note, if you already have an existing business loan that is not idle, we can refinance, consolidate merchant cash advances, depends on how many. Usually the majority of them, two, more or less, depends on the lender, but more so also on the balances of what you have. Monthly repayments, interest rates. I have a separate video again. We already spoke about that, and those numbers can be readjusted. But prime rate 7% plus 1 to 3.75%. But you're seeing like prime rates plus 2.75 for a lot of these over 350,000. It could be prime plus 2.25%. That can be a low entrance, and that may be up to 7 years instead of up to 10 years. The 10 years you might get 2.75%, but that is amortized differently. You get an extension of 3 years, so it ends up dropping your repayments regardless. And so even a little bit higher, you're looking at interest rates, prime plus even 4.75% for express loans, 3.7 to 6.75 even for those in a lot of cases. So I'd say somewhere between seven being hard to get right now, and the market will shift. So you'll probably watch this later, it'll be higher, more or less. But maybe shoot for something like 9.25 to 12% in today's market, or it can even be at 12.75, 9.25 to 13% in some cases. And more or less it gets shifted. So 2 years of profitability, the credit score there, business credit is what we want. FICO SPSS scores of 155, business liquid credit. Sometimes we can look at it less if it's an express loan, but 155 is best. Termination, personal business. So I won't go too much into this. I made a separate video, look down below. And what you'll want to do, and I'll show you shortly, why this is the best and what you should go through. Okay, not have these, and what we'll need depending accordingly on the year. And I may or may not have attached it, but if you're patient enough, we can get you bridge funding in the meantime. Even if you don't want it, we can then at least know what you'll get. And if it's a soft approval, perfect, it works. That's what they are. And if it's a hard pull, there might be one or two lenders, but we'll ask you and we'll tell you, hey, can we do this, or we want to do this? This is how it works. So you'll know, usually it's soft pulls for these. And on top of this, there may be an employee retention tax credit situation. So I'll leave more of this on a separate video down below. But what I would do ultimately is fill out this questionnaire that I'll link you to down below in the description. You can fill it out literally in less than 30 seconds. It'll look like that. But you may start off here. Because SBA 7A loans for startups, there's microloan programs, but as a startup, it's hard. You're purchasing a business, that's another situation where it could work better. There's a community advantage program too, but you're purchasing a business. Most people don't even have the down payment. Is the business profitable? Is there some form of business credits being established there underneath the business? Have you relevant experience in it? If you don't, I mean, it can be more difficult scrutinizing. Like you have to be a previous business owner to get a business loan acquisition a lot of times. The relevant experience is going to help you. And there's other ways of getting that financing you can use as a down payment and making sure everything else lines up. You have the right business plan, how you plan to service the debt, and what your plans are for using this money, and everything else, how you plan to operate. So it'll look like that more or less. And you can click one of these two, non-startup, or you are a startup. If you're a startup, you'll go to a different section. Non-startup, this way I can communicate with you better. And both of them will kind of look more the same once you're on this page, but there's different ways for me to communicate with you on the back end. So fill that out. You can literally get started on the thank you page and or wait for me to give you a response. So what I do, evaluate, analyze your answers, and I give you a personalized and customized email response for your best funding option and options, whether you can qualify for them or not. At least you'll know. Plus, you'll get our free 6-step group loan lending checklist to get you approved for funding much faster. And you can wait for me to send you that. Starting on the thank you page, you can do that and or. But I also have a Business Funding Mastery Academy course that I just released that I will leave you guys down below in the description. So it'll give you an A to Z video series and show you, or more so video format, and unlock lessons and modules on where you should start, how to build yourself up over time, and what you should do there. So just to recap, we went over here the 0% interest. That is a business credit card building program. You can get access to credit lines at 0% for 6 to 18 months, depends on the business credit card that you have, whether that's one for 100, 50, 60, whatever it is. amounting to 150,000, or you can even get up to 250,000 with corporate credit. It's a great one. And yes, for that time, you should know what you're using your funds for, because it expires. Then what will you be paying back? Can you sufficiently pay it back? So it's about being strategic and taking on good debt versus bad debt. So there's an interest program to that. If you want to learn more about this, I'll leave content down below on the hybrid line of credit, excuse me, Hybridge. So check that out down below. We went over debt service coverage ratio and the different given unknowns, unknown here being our DSCR. We broke it down and how to calculate that. If I needed to if I need the DSCR, what would I have to divide and multiply to get my X over to my 1.25, multiply that by X, and then I divide 1.25 by the number, then I will be given my other part. And so we didn't go into that too much, but there are different ways for me to calculate. And so you got to see that net operating income, total annual debt service, what those are, DSCR, and over here, the NOI divided by total debt service coverage, or debt service, excuse me. We've always seen the two. And then that'll give us our DSCR. The higher the DSCR, the better. 1.25 is usually a minimum. They can go more or less, but if they drop it down, it's like you better be cash flowing heavily, like making more to get approved for more. But 1.25 is the general basis. We went through some examples. So 1.25 for every $1, that's 25 cents you're making in return, and it has to be 125% or 1.25 times the debt that you're ongoing and concurring. So 7%, we gave you some examples of what that would look like, plus 2.25% at 9.25%. Perhaps that's an SBA standard loan, not an express loan, and you're getting up to 10 years at 9.25% in interest rates, how it's amortized, principals and interest. Debt service coverage ratio, we said 1.25, NOI, 100K example, 80,000 on total annual debt service, monthly repayment of $6,667. Now over here, we have a total maximum of 520,000 plus. And then what it could look like year over year, profit margins. And we look at that and can kind of see an average and do a better assessment with other things like collateral, if any. Doesn't always have to be given. Collateral is not the primary thing that they look at. We may ask for it, but it's not like we're going to disqualify you. Certain lenders won't do that. And then we can make a readjustment with that term-wise, number-wise. Example 2, went through that. Example 3, we had different DSCRs and different numbers. And then EBITDA, we went over that, earnings before interest, taxes, depreciation, and amortization used as an indicator of overall profitability of a business and your business or businesses. And then we went through some of the different things like with the Hybridge SBA 7A loan. That I'll leave more down below. And there's different services. If you don't qualify for an SBA 7A loan, don't believe that you are out of luck. There are more solutions that may not be as fast, but you have to build it. Like business credit, to get approved for an SBA loan normally can take 4 months. But in this market, we're seeing 6 to 8 months to have sufficient trade lines, to have everything reporting correctly. And to fix your personal credit, that can take maybe a month to 3 months, whatever you're having to report, dispute, and everything. So while you're doing a few things, you have to keep into account, like, how do I get my credit up? Personal, how do I get my business credit the right way? How do I monitor it? What do I need to do on all of that? And all of this will help. The better you have it, the better approvals, the more trust. And so that, I believe, let me look over here to make sure I covered everything. So 9.25 to 11.75%, a lot of interest rates you're seeing right now with SBA loans, even above 11.75%. You might even get 7 to 1.25%, but it's very commonly you're seeing in the 9% range right now. And prior ranges, I already covered that. The less you borrow, the higher interest rate. So one other example that I didn't get into is, well, I kind of more or less said it. Let's say your interest were to change and you maybe had it go up. Maybe you had a 10% interest. Well, because we did a quarterly change, or maybe because that's what we were assessed at. Now, the amount that you may get, we'll have to make a readjustment on this. But let's say this time you were only going to be given 485,000, a significant difference perhaps, because we had to make readjustments. Or it can be where the payment's still the same. The years would probably drop it down to 7, and the interest probably stayed the same. Let's say we were given 9.25, then the payment would still have to come down to a degree and we'd look at other scenarios, perhaps it would be more because of over 7 years. Maybe you're seeing a 415,000, and then on top of what you will have other things. And so that's what I want to leave it at. Hopefully you got value out of this video. EBITDA we went into, maximum loan amount payments that you can expect. How do I get an OI? There's a few other equations that I can do. There's a lot more that I do on my back end. And then for different services, it's different. It won't be like this for other types of products all the time, so don't expect that. I know this is like SBA related and other business loans, but it's not always this way. Just know that. There's other ones we can approve just off of bank statements and annual monthly sales within the last 3 months or whatever that is, revenue lowest month. But you won't know until you fill out this questionnaire. What is your best funding option and options? You more or less saw one, but there's more to this equation that I can show you via an email response. You can get started right then and there. So if you got value, please give it a thumbs up. Share with others who you feel will get value out of it. It can be a complete stranger, a friend, or a family member, but you know you were able to help them at the end of the day. And if you haven't subscribed, please go ahead and do so and click that bell notification icon so you do not miss any future videos like these mathematically, logically, and all else, keeping you up to date on the market and what's happening. But get in sooner now rather than later. I have a lot of people who are getting SBA loans as we speak, getting prepared. Whether they needed that for the 5th year, the 6th year, they'll have it there. And it's not like you always need to have money sitting there. You got to make the use of what you have for those growth and expansion setups and say, hey, I'm only given 8 months. I was only given 12 months, 15 months, 18 months, whatever that is. Take that and say, what's my return on my investment, short and or long term? Can I take something with this? Can I get approved for more in the next time? Can I get better rates and terms? Yeah, that can happen. Better partnerships and relationships? Yes, absolutely. That'll help you. Needed a down payment? Perhaps a personal loan works best. Or what did you need to do? You needed to figure out a down payment. So we took a cash out advance, applies towards business acquisition, and or we do a combination. Maybe it's an equipment loan. But there's so much. So that's everything from me. Appreciate you for tuning in. Look down below in the description for that questionnaire form and all else to get started. Talk soon. Bye.